Hello viewers, I am Sanjeev Pandya welcoming you to another episode of the Tax Time, Your Taxes Matter. In this weekly show, as you know by now, that we bring you latest on the taxes. Not only the changes in the taxes for this year, but also the things that you should know in the different categories when it comes to taxes, because taxes is a very, very wide subject. So we try to give you as much information possible in this show, and of course with the help of Mr. Ajay Kumar, CPA of SAI CPA Services. I'd like to welcome him to this show. Alrighty, how are you doing?
I'm doing great.
All right. Before we go any further, of course, it's the tax time and the tax show on IRS. You know, this is the famous word that you hear nowadays.
Or Uncle Sam.
Our Uncle Sam. But the word the and IRS, all right, the IRS.
Right.
If you put them together.
This is theirs.
Theirs, exactly. So whatever you make, it's theirs.
Theirs
Absolutely. The way they figured it out, it's pretty smart.
Yes,
you know?
I know.
And you know what Form 1040 stands for?
What's that?
Or the Form 1040 stands for that you make 50, you keep 10, you give away 40. That's what 1040 stands for. Anyway, folks, it's just a light humor to start our episode here. Last week, Ajay ji, we talked about charitable contributions.
Yes.
It was quite informative show, and you gave out a lot of details and everything. The reason I'm referencing to that is that because charitable contribution, we talked mainly about giving charities to the foreign entities, U.S.-based entities,
right,
and the non-profit associations, whatever it is. If a family member gives a contribution to another family member,
wow,
the reason I say contribution, right? Is it taxable? Is it tax deductible, or can it be justifiable?
That's a great question. So just to remind our viewers, all the charitable contributions or when they are given to the family members are referred as gifts. So charitable contributions have different limits as the gift limits.
Okay.
So charitable contributions, as we mentioned in our last episode, are allowed up to 60% of the AGI. If somebody is making $100,000, they're allowed to give up to 60%, $60,000 to any charitable organization, as long as it's a qualified organization, as long as it's registered with the IRS, 501c3. And we mentioned the foreign gifts are not allowed as deductible. You're allowed to give the gift, you're just not allowed to deduct that contribution on your personal tax return.
It's a quite a complicated matter, charitable contribution. So in this episode, if we can talk about gift and estate taxes.
Absolutely.
Many people are not aware of it, or maybe they don't have enough information.
Sure.
So why don't we give out information on a gift and estate taxes. First of all, can a family member give a gift to another family member? And if answer is yes, then what's the limit?
Absolutely. So the gift tax limit is $15,000 for this year, for 2019. Up until last year, it was $14,000. It changes every year, every so often. For 2019, the gift limit is $15,000 per person to per person. What it means is, I can give $15,000 to somebody, my wife can give $15,000 to somebody in one calendar year. So if you look at a typical family of four, 2 parents, 2 children, they're allowed to receive up to $60,000, 15 each, from one person per calendar year. And if you take it one step further, you can take this much gift, $15,000 in December and $15,000 in early January, because the limits are based on calendar year as opposed to based on 12 months period.
Okay, so now you mentioned this husband, wife, and let's say 2 children. Gift is only within the family, or it can be extended to, let's say, immediate family members or after immediate family members. Let's say, for example, nephew, niece, cousin. Can it go that far?
That's a wonderful question. So the gift does not define the relationship. The gift can be given and can be received from anybody. You don't have to be related.
Achha.
You don't have to be even friends to receive the gift or to give the gift.
Okay.
You can be giving this gift to anybody. So the difference is when you are donating money, as we discussed in our last episode. So this donation to the church is tax deductible. But what if you give the money to the pastor, to the priest over there?
Which is not tax deductible.
Which is not deductible.
Deductible.
Then it becomes a gift.
Correct.
The priest is not related to you, or you don't even have to be friend. You're giving
so
the
you
gift
can define as a gift.
that's defined as a gift. And that limit from per person to per person is $15,000 per calendar year.
Acha. Per person to per person. So if I understand that correctly, is that if I gift you $15,000, it's not taxable to you. And it's not taxable to me, right? To the both parties.
Absolutely.
All right. If you go above $15,000, then what's the tax brackets and what are the forms to file?
That's a great confusion out there, that if I were to give or get
Ji.
more than $15,000, how much tax do I have to pay?
Ji.
So the way the IRS looks at it, there is a lifetime exclusion. And right now, for 2019, the lifetime exclusion is $11.4 million per person. So it's a large exclusion. So there is a filing requirement. If somebody is giving the gift of more than $15,000, they are required to file a form, 709 form, which is easy, not too complicated, but there is no tax liability as such. The requirement is all about filing the form, so we can track, we can see how much gift in their lifetime they have given. So we can see if it's more than $11.4 million, then they have to pay some estate taxes. Up to this limit, there is no tax, it's just the information filing requirement to file Form 709.
That's up to 11.4 million, you said?
Through the lifetime.
Through the lifetime.
Yes.
Okay. So now let's say if somebody's got a, I guess, a very, very wealthy person, very wealthy family, and hundreds of millions of dollars they're worth. How does estate come into it? Because this is also good, and obviously you need to have a will and everything. If you don't have a will, then estate tax can be complicated to figure it out, and there could be a confusion or fighting among the family members.
Absolutely.
These are the things occur a lot because of not having will. The reason I'm bringing will is just because taxes are also related to it,
Absolutely.
right? So if there is a will, and if somebody wants to give more than $11 million because they got so much money, then how does that work?
Then they have to file the estate taxes.
Okay.
So the trick is, you don't really get $11 million on one day. You accumulate this wealth throughout your life for your family. So if you have, say, stocks and they are growing, and you see growth, and you will know that this stock will be worth a couple of $1 million, or this portfolio will be worth a couple of $1 million. Or if you have a property, inherited property, if you were to gift that property, it's going to be a couple of $1 million. The trick is, if you gift that asset early enough to a trust.
Okay. You set up a trust. Okay.
You set up a trust, and let's say that the house is worth $1 million now. I know by the time my kids grow up to 20, by the time they need it, this house will be worth, let's say, $5 million. And at that time, this $5 million will be taken out of my annual limit, which is 11.4 today. So the trick is, if I were to give that, if I were to gift that house by filing proper form, and there is no tax liability because I haven't crossed the 11.4 yet, if I give that house early enough to a irrevocable trust for the benefit of my children,
then you can avoid taxes.
Then I can avoid taxes because the gift is considered 1 million, not at the future value.
I see. Okay, that is a very interesting point, and I'm sure that our viewers will definitely find it very interesting. All right, so that's the start of gift and estate taxes. We're going to take a break. When we come back, we're going to talk about in the gift and estate taxes, what's taxable, what's not taxable. That we all need to know. It's coming up right after this messages. Please stay with us. Welcome back to the second segment of the Tax Time. Your taxes matter. I am joined by here Mr. Ajay Kumar, CPA of SAI CPA Services, and in today's episode we are talking about gift and estate taxes. In the first segment, Ajay ji gave us a basic information on a gift and estate taxes. I've got a very simple question for you. What is a gift as per IRS?
Absolutely. A gift is not just giving money to somebody. A gift could be paying somebody's expenses. Somebody owes something to somebody and you're making a payment on their behalf to the third party. That's actually a gift to this person. A gift could be giving somebody something below the market value. Meaning this house is worth $500,000, I'll give it to you for $400,000. In that case, I gave a gift of $100,000 to this person. A gift could be debt forgiveness. You owe me this thing, you don't have to pay it. That's also a gift. So a gift could be many things.
So up to $15,000, the person who gives, obviously the person is doing it at his or her own discretion, and
Right.
they are saying, fine, I'm going to give you that gift. But the person who receives it and has, and doesn't have to pay any tax on it, that's a kind of good benefit.
That's a great benefit.
For
That's what-
$15,000, it's not a small amount.
It's not a small amount, and this 15,000 can be replicated. You give me 15, your wife gives me 15, give 15 to me, 15 to my wife, 15 to my children.
Okay.
So you can really increase this amount.
But it must be reported.
It needs to be reported in only certain situation. Say, for example, if the gift given is more than $15,000, then there is a filing requirement. The second situation that we commonly see, if the gift is a future interest gift, if you give a home, if you are gifting a home. So why there is a filing requirement? Because this home is going to be worth a couple of $1 million 20 years from now.
Okay.
But this house, this home is not worth that much. So we need to do a filing to let
Okay.
the IRS know
I see.
how much is the market value
Okay.
of this current gift. The third situation that we see when the gift filing is really needed, when you are splitting a gift. So I gave this gift to you and your wife together, and I'm not stating here how much is your portion and how much is her portion. In that case, a gift filing is required to let the government know this is your portion, this is her portion.
Okay.
So when you are splitting the gift, or when you are giving a gift for a future value, or when you are giving a gift more than $15,000 in cash check, then a filing is needed.
Okay.
But here is the trick here, Sanjeevji.
Yes.
A gift filing, the obligation remains on the giftor, not on the giftee. So the person who is giving the gift is obligated to file the return, not the person who is getting the gift.
Correct. Okay.
And there is no tax liability as such. It's a misconception. There's a lot of confusion about it. Oh, if I take more than $15,000, I may have to pay taxes. How much tax do I have to pay if I take $20,000 in gift? There is really no taxes. In these small gifts, the limit is $11.4 million for the lifetime. There is a filing requirement, Form 709, which is very simple. It's not too complicated.
Okay, interesting. All right, so before we go into the gift and estate and what's taxable, what's not taxable, one question comes to my mind. So far, it's really good, and you made it very clear about gift and everything. Let's say I have a company, one of the companies, S Corporation, C Corporation,
Right.
Limited Liability.
Which we discussed in one of the episodes.
Which we did a
Yep.
couple of weeks ago, right? Can I gift someone from the company books and still not pay tax on it?
Well, the person who is getting the gift,
They
they,
will have
don't
to
have
pay-
to pay taxes on it.
They don't have to pay tax.
But if they are not paying the taxes on it, then you are not able to deduct as an expense on it.
Oh, okay.
So the way you do it from the company, if I'm giving the gift, in theory, I took the money out personally
From the
company because I own the company, and then I gave the money to this person. If the company is giving, either it's a loan to the person that
Or
which
a
you are
gift.
expecting back, or it's service income. If we want to deduct it in the company, then that person must report it as income.
Oh, I see.
If this company is not deducting it, then this person doesn't have to report it.
Okay.
Then the way the government looks at it, the company owners withdrew the money to their personal account, and then from the personal account, we gave the money to this individual.
I see. So even though if it's a S corporation, which flows through your personal tax returns, right? You are saying it's not advisable to give a gift from that corporation as well, S corporation?
Well, there is no tax benefit of giving gift directly from the S corporation or LLC or C corp to that person.
Right.
In any event, it's seen as if you withdrew the money first,
I see.
and then you gave the gift.
Okay, good. Now with that note, let's go to taxable and non-taxable categories when it comes to gift tax. When it comes to gift tax, now you mentioned transfers below market value is taxable, but gifts to political organization,
Right?
taxable or not taxable?
Gifts to political organizations are non-taxable. But let's understand what's non-taxable. Non-taxable to who? Right? So gifts to political organizations are non-taxable for the political organization. So the political organizations do not have to pay taxes on the gifts that they are receiving.
Ji.
So gifts to charitable organizations are not taxable for the charitable organization. So a charitable organization, a qualified charity, 501c3, collecting gifts from everybody, they don't have to pay any taxes on that income.
Okay.
a spousal gift,
Yes.
gift to your wife or husband, is not taxable, and there is no limit to it.
Okay. And gifts to charities or charitable organization that you just mentioned, also non-taxable.
It's non-taxable for the charitable organization.
Okay. And if all those things, limit still remains $15,000.
Well, gifts to charitable organizations have no gift limit. Gifts to political organizations have no gift limit. Gifts to a spouse, there is no limit to it.
Okay.
When you are giving gift to somebody else, person to person, 15,000 per calendar year, that's where the limit comes in.
Okay. All right. So now after that gift taxes, what can you tell us about estate taxes?
The estate tax limit, Sanjeev ji, is $11.4 million per person. The trick here is, if you really have that type of asset, you start planning sooner. So you can put some of these high value assets, the assets that you are expecting to appreciate soon enough, in a trust, in an irrevocable trust. So those assets can be taken out of your trust early enough before you hit the $11.4 million limit.
Okay. When do you think somebody should really consider about estate tax for themselves? I mean, when they're wealthy enough, but how much you think that they're worth and they should really consider about estate taxes, and if they have young children, let's put it that way.
Well, the way I explain it to the clients, even though the gift limit, the estate tax limit is $11.4 million now, which used to be $5 million, but this limit is only for 6 years. These limits in theory can go back to what they used to be or lower after 2025. So there is no such limit on the how much money you have to have before you start planning for your wills, for your estate, for your trust. You should have some sort of plan early enough. If you have a couple of $1 million, that's good enough. Even though the limit is 11.2, you want to sit with the accountant, with your...
Start planning now, because
start planning sooner.
Because if money starts growing, then
Absolutely.
in just a couple of years, obviously it will go beyond 11.
And you create a framework for yourself, and you keep working on it. Every year you file the taxes. Every year you know what your net worth has grown. So you create a framework early enough, and then you keep fine-tuning your framework.
Okay. All right. That's good to know. And with that note, we're going to take a break. When we come back, whatever that we have more on gift and estate taxes, we'll definitely talk about it in the third segment. You please stay with us. Welcome back to the third segment of the Tax Time. Your taxes matter. This weekly show right here on TV Asia. Before we go any further, viewers, I just want to remind you that if you have any tax related question and want to know something specific on any tax category, you're most welcome to send us an email. taxtime@tvasiausa.com. Do send us an email, and Mr. Ajay Kumar, CPA of SAI CPA Services, will definitely help you out with the answer and give you as much detail possible. So once again, our email ID is taxtime@tvasiausa.com, and we encourage you to send us an email. Any tax related question, no question is a small question, and no question is a silly question when it comes to taxes. Even if you ask us, why do I have to pay taxes? Ajay ji will answer that question too. Why do you have to pay taxes?
I'll be happy to.
All right. So gift and estate taxes that we covered in the first two segments in this episode. My question to you now is that although you made it quite easy to understand, will you be able to share some true stories of your clients, or some, I would say, class examples that how you help them or how they manage their gift and estate taxes?
Absolutely, I'll be happy to. So let's take an example on donation versus gift. So please understand, viewers, when you are gifting money to a friend, to an individual, to your family members, it's not donation. It's not deductible. We had an audit situation. This client came to us, and this client was claiming $30,000 under donation. His income was about $100,000, $110,000. IRS wanted to audit. $30,000 at $100,000 is pretty high, even though legally allowed up to 60% of AGI. But it was, comparatively speaking, statistically speaking, it was a high number. We looked at the tax return, we asked for the receipt from the client, and the client had donated money to uncle and aunts and the family members and the priest. And he said, this is not donation, this is gift. Even if you go to temple and you're giving money to the priest, that's really, really not donation. Money needs to go to the temple, the organization, in order to be deductible. If you're giving money to the president of the organization or to the treasurer of the organization, that's not deductible, that's a gift. That you cannot deduct that on your personal tax return.
Absolutely. So, and then you obviously help to clarify that matter.
Absolutely.
And once you gift to a temple or any organization, make sure you have a receipt if they are
absolutely
501c3, right, in order to accept gift contribution.
As we mentioned in our last episode, the receipt has to be contemporaneous receipt. What it means is, you cannot really tell IRS once the audit starts, oh, I can get the receipt. No. That's not the way it works. You must have the receipt at the time of filing the tax return. When you file the tax return, did you have the receipt or not? If you don't have the receipt at the time of filing the tax return, you're not allowed the deduction for it.
I see. Earlier you mentioned $15,000 is the limit. So question that I have for you is that $15,000 is the limit per person.
Right.
Husband and wife filing a joint return.
Right.
Can they give $30,000? One can say it's from husband and the other $15,000 is from the spouse, wife.
That's a great question. In theory, the total is $30,000, Sanjeevji. But it has to be 15-15 from each person. You cannot really have 20,000 gift given by the husband and 10,000 given by the wife.
So would you be okay if there are two checks of $15,000 from the joint account?
They have to be separate 15-15 checks.
15, obviously, that's what.
Absolutely.
Since we can't write one check for $30,000 because IRS limit is $15,000,
Right.
we know that. But husband and wife filing a joint return
Right.
and have a joint bank account, so would you be okay as a CPA and for IRS rules that if there are two checks of $15,000 and $15,000, it's okay?
In theory, they are okay.
Okay.
The trick is, the gray area is, the question we get, do they have to be signed by one check by the husband, one check by the wife? And there is no such rule. As long as the account is a joint account, we can leave with two checks of 15,000. What we try to stop is, don't write two checks, one check for 20,000,
and
one
the
check for
10,000.
10,000.
Yeah, you can't do
but
that.
along the same lines,
Yeah,
Sanjeev,
please.
there is a rule called portability,
Ji.
which is not applicable on the gift side, more on the estate side. Let's say the estate limit is $11.4 million,
Ji.
right? And if a spouse happens to disease sooner, then just to make sure from that spouse the limit is not lost. Let's assume the total husband-wife have $20 million of net worth. So 10 million belongs to husband, 10 million belongs to wife, and the one of the spouse happens to pass. Then by filing the form, it's called 706 estate form, the surviving spouse can port the remaining limit to the next spouse.
I see.
But there is a special form that has to be filed, even though, and it comes part of the estate planning, even though you are not required to because you are under the limit.
Correct.
But if you were to file that form, the surviving spouse get the leftover amount from the spouse who passed away
Ji.
to make sure they can cross 11.4 million to 11.4 plus what was not used earlier.
Oh, okay. That's a very good point that you mentioned. As we come to an end of this episode, any advice that you can give to our viewers when it comes to gift and estate taxes? What should they be careful and what should they really, really consider?
Absolutely. So that the trick here is use a shoebox approach. A lot of times people go to temples, a lot of churches. They know that they gave $100 over there. They know they gave $500 and they have the receipt for it. What they are missing is going to the temple, going to any charity if you are working over there is also deductible. Your mileage, your gas expense, anything out of pocket that you spent other than your time value is not deductible.
Correct.
But going there, coming back, anything that you had to do out of pocket, even if you were mailing out some letters for the temple, the stamp that you put on, if you are paying from your pocket, that's a deductible expense.
Really?
So use a shoebox approach. You spend some money, take the receipt, throw it in the shoebox. You don't have to worry about it. You can look at it at the end of the year, at the end of the quarter. But if you have everything placed in a single box, it will be easier for you to find some donations.
Okay, on the way back and forth, you say mileage and everything, or even
Absolutely.
the gas, everything can be considered. If I decide to stop by for lunch or snacks, would it be deductible?
No, but it depends who you're having the lunch with.
Oh, I see. All right, so next week when we come back, we're going to talk about...
Next week, we want to talk about mortgage, home equity line of credit, property tax. There's a lot of confusion and a lot of limits have changed under the tax reform. In our next episode, we'll try our best to clarify some of the doubts that our viewers have to make sure they have the right information.
Alrighty, with that note, of course, we come to an end of this episode. Ajay, thank you so very much. Next
You're
week's
welcome.
episode is going to be very informative and interesting as well, just like any other episodes. Remember, any question, tax-related question, please send us an email, taxtime@tvasiausa.com. I am Sanjeev Pandya, wishing you all happy and tax-free week ahead.